Three words. Three words that have cost investors more money than any other phrase in finance. On April 20th, 2022, Netflix investors woke up to a nightmare. $54 billion in market value. Gone. Overnight. The stock crashed 35% in a single day, the biggest one-day drop in the company's history. And what did thousands of retail investors do? They rushed in to buy the dip. 6 months later, the stock fell another 40% from there. But here's the thing nobody tells you about those returns. Some of those dip buyers eventually made their money back. Others lost everything. Same phrase, same action, completely opposite outcomes. The question isn't whether buy the dip works. The question is, which dip are you buying? Let's be fair to the buy the dip crowd for a moment, because the data looks compelling on the surface. Backtested on the S&P 500, buying the dip has a 76% win rate. Sounds incredible, right? 3 out of 4 trades are winners. But dig into the numbers and the picture changes. That strategy returned 5.7% per year. Buy and hold? 9.5%, nearly double, and you didn't have to do anything. Now, the dip buying strategy was only invested 16% of the time, so the risk-adjusted returns look better. But here's what matters. The strategy worked because it was applied to the S&P 500, a broad index, 500 companies, a structural uptrend that has lasted over a century. Buy the dip on an index in a long-term uptrend? That's a reasonable strategy. Buy the dip on an individual stock in a downtrend? That's gambling with extra steps. And that's the distinction nobody makes. Now, most people would stop here, but the real story isn't in the averages, it's in the casualties. Let me show you what I mean. The year is 2021. The market is ripping higher. Everyone is a genius, and 4 stocks are about to teach investors the most expensive lesson of their careers. Meta, the company behind Facebook, Instagram, WhatsApp. Peak price, $382 a share in September 2021. Over the next 13 months, it fell to $89, a 77% decline. Investors who bought the dip at $300, they watched their money get cut in half, then cut in half again. Netflix, $700 a share at its peak in November 2021. It crashed to around $166, 76% decline. That $54 billion day I mentioned, that was just one of the drops. There were several. Now, here's where it gets interesting. Both Meta and Netflix eventually recovered. Meta is now trading around $600. Netflix came all the way back too, so the dip buyers who held on were eventually made whole. But that's only half the story. Stay with me because what happened next is where it gets brutal. Peloton, the pandemic darling. Peak price, $167 in January 2021. The stock went public at $29. It seemed unstoppable. Dip buyers piled in at $120, then at $100, then at $80, then at $50, each time thinking, this is the bottom, this is the deal of a lifetime. Today, Peloton trades around $6 to $7, down 95% from its peak. Those dip buyers at $120, they've lost 94% of their money. 4 years later, no recovery in sight. Carvana, same story. Peaked above $360, crashed to near bankruptcy, revenue of nearly $3 billion, and they still couldn't make money. So here's the question. Why did Meta and Netflix recover while Peloton and Carvana got destroyed? Same dip, same action, opposite outcomes. The answer is one word: context. Meta and Netflix dipped, but they dipped within a larger context that was still intact. Both had dominant market positions. Both had massive growing revenue. Both had temporary problems. iOS privacy issues for Meta, subscriber saturation for Netflix, but the underlying business engine was still running. They were in an uptrend that hit a speed bump. Peloton and Carvana, their entire business model was unraveling. Peloton's demand was structurally declining as people went back to gyms. Revenue fell from $4 billion to $2.5 billion across 4 straight years of decline. They were burning through cash. The stock didn't dip, it collapsed. And it collapsed because the trend had fundamentally changed. This is the distinction that separates investors who build wealth from investors who destroy it. A dip in an uptrend is an opportunity. A dip in a downtrend is a trap. Same word, dip, completely different reality. And if you can't tell the difference, you're flying blind. So how do you tell the difference? Here's a simple context checklist. Before you buy any dip, ask 5 questions. 1. What's the trend? Not the daily chart, the weekly, the monthly. Is price making higher highs and lower lows, or lower highs and lower lows? If the structure is broken, no amount of it's on sale changes that. 2. Is revenue growing or shrinking? A company whose revenue is falling is not on sale, it's in decline. Peloton's revenue fell every year for 4 straight years. That's not a dip, that's deterioration. 3. Is the problem temporary or structural? Meta's iOS issue was temporary, they adapted. Peloton's demand problem was structural, people went back to gyms. Temporary problems create buying opportunities, structural problems create death spirals. 4. Is cash flow positive or negative? Companies burning cash have a countdown timer. Peloton burned through $3.7 billion in negative free cash flow. That's not a company finding its footing, that's a company running out of road. 5. Would you buy this stock if it had never been higher? Forget what it used to trade at. If Peloton had never been at $167, would you look at a company with declining revenue, negative cash flow, and shrinking subscribers and say, yes, I want to own this? Probably not. That's 5 questions, takes 5 minutes, could save you 5 figures. But here's where everything changes, because there's a way to play this where you don't even need to be right about the exact bottom. Let's say you've done the work. You've identified a dip in a genuine uptrend, strong business, temporary problem, cash flow positive. The context checks out. Most people would just buy the stock and hope, but there's a smarter approach. Instead of buying the dip, you can sell put options on stocks or indexes where you've identified an uptrend context. Here's why this changes the game. When you buy a stock, you need to be right about direction and timing. Buy too early and you sit through more pain. Buy too late and you miss the move. When you sell premium, time works for you, not against you. Every day that passes, the options you sold decay in value. You're getting paid to wait. If the stock goes up, you keep the premium. Profit. If the stock goes sideways, you keep the premium. Profit. If the stock dips a little more but stays above your strike, you keep the premium. Profit. The only scenario you lose is if the stock crashes significantly below your strike, and if you've done the context work, uptrend intact, strong business, temporary problem, that scenario is far less likely. You've gone from needing to be right about direction and timing to only needing to be roughly right about context. That is a massive edge. This is the evolution, from buy the dip to sell premium when the context is right. Less dependence on direction, less dependence on timing, more dependence on the one thing you can actually analyze, context. So let me leave you with this. Buy the dip isn't bad advice, it's an incomplete advice. It's a half sentence that's missing the second half. The full sentence is, buy the dip when the context confirms the trend is intact. And the evolved version is, sell premium into the dip when the context confirms the trend is intact, so that time, decay, and probability work in your favor. The people who lost 95% on Peloton didn't have a buying problem, they had a context problem. They saw a lower price and assumed it meant cheaper, but cheaper and better value are not the same thing. A 50% discount on a sinking ship is not a bargain, it's a trap. The next time someone tells you to buy the dip, I want you to ask one question. Which dip? Because that question, that single question, is the difference between building wealth and watching it evaporate. You're not just a buyer of dips anymore, you're a reader of context, and that changes everything. If this reframed how you think about buying dips, hit subscribe. I break down market frameworks that cut through the noise every single week. Drop a comment. What's the most expensive dip you've ever bought? I want to hear your stories. And if you want to learn how to identify the 6 market patterns that actually make money, including how to sell premium with context on your side, I'll link my training below. I'll see you in the next one.